Hi, this is Dan Collins, Editor-in-Chief of Futures Magazine for Traders Exclusive. Coming to you live from the CME Group in the middle of May, and a day that we've actually seen snow in the Chicago area. It's a good time to say you should need to be prepared, because even in May we have snow showers in Chicago. I'm going to give you a little preview of our June issue that we just kind of wrapped up, and you'll be able to see on June 1st at futuresmag.com. We talked to Lee Partridge of Salient Partners, who's constructs portfolios and has built some 40 Act fund managed futures products and other products. Talking to Lee, it's a little disturbing that he says what he sees in the portfolio in the pension area is that people are kind of letting their guard down because this bull market in equities has gone on so long, and they've reduced their exposures to alternatives, and it could be right at a time when people need them most. Kind of just remind everybody that if you in a 401k and if you have that exposure to the equity market, that's good. They go up. You don't want to take that exposure away because, as people say, the markets can continue going up regardless of your perspective. So bull markets tend to go to overshoot, so you don't want to try and predict when they're going to end or they're going to reverse. You want to keep that exposure while protecting your downside. You could do that with buy rights, you can do that with tail protection. But what's really important, and what we learned in 2008, is you need an exposure to managed futures, which is the best diversification in terms of non-correlation and actually negative correlation to equities. And after a 5-year bull run, it would really be a bad time to lose that exposure. As I said, if you have that exposure to equities, it's good. Maintain it, protect the downside, and also have something non-correlated, something that can be negatively correlated. Because what we did learn in 2008 is a lot of the alternatives did not provide what they're supposed to. And that's because they were equity-based, and even if they're long, short, there's always that bias towards long equity. So you have to look at your portfolio and make sure that you have things that will do well if equities go down. And that's not certain hedge funds, equity-based hedge fund strategies don't do that. So you need managed futures. We pointed out how in the last 3 years, even though managed futures struggled, discretionary ag and commodity-based programs did very well. So that's an added diversification. So have systematic allocations and diversified allocations. Now is particularly not a good time to let your guard down. So make sure that you have a well-rounded portfolio with alternatives, with managed futures, things that can do very well if the equity markets do turn south. This has been Dan Collins, Editor-in-Chief of Futures Magazine. Talk to you next time.